Startup valuations. They're like whispers of mythical creatures, shrouded in speculation and intrigue. Everyone's talking about them, but few truly understand them. How can a young company, barely out of its infancy, be worth millions, even billions? The answer lies in the heart of entrepreneurship, the ability to transform an idea into a future behemoth. This isn't about magic, though it might feel like it sometimes. It's about understanding the language of investors, the tools of valuation, and the art of crafting a compelling story around your startup's potential. This video will demystify startup valuation, providing you with the knowledge and confidence to navigate this exciting, albeit complex, world. Simply put, startup valuation is the process of determining the economic worth of a young company. This is a critical step for any entrepreneur looking to grow their business. Think of it like assessing the value of a house before you buy it. Just as you wouldn't purchase a home without knowing its value, investors won't invest in a startup without understanding its worth. You consider its size, location, condition, and compare it to similar houses in the market. These factors help you determine if the house is priced fairly and if it's a good investment. Similarly, startup valuation considers factors like revenue, market size, team strength, and competition to determine its worth. The process involves a detailed analysis of the startup's business model, growth potential, and financial health. This valuation is crucial for several reasons. It not only helps in understanding the current value of the company, but also in planning future growth strategies. First, it's essential for raising capital. When startups seek funding, they need to present a convincing valuation to potential investors. Investors need to know how much equity they'll receive in exchange for their investment. A clear valuation helps in setting expectations and terms for the investment. Second, a well-justified valuation builds investor trust. It demonstrates that the startup has a solid understanding of its market and financials. It shows you've done your homework and have a realistic understanding of your company's worth. This can be a deciding factor for investors when choosing where to put their money. Finally, it provides a framework for negotiating deals and partnerships. A well-defined valuation can help in structuring agreements that are beneficial for both parties, ensuring long-term success and collaboration. One of the biggest misconceptions about startup valuation is that it's solely based on current revenue. While revenue is important, it's only one piece of the puzzle. Startups, unlike established businesses, are valued on their potential, their ability to grow exponentially and disrupt industries. Imagine a seed about to sprout. It might be small now, but it holds the potential to grow into a mighty tree. Investors are betting on that potential, on the belief that your startup will blossom into something extraordinary. Therefore, valuation takes into account not just what your startup is today, but what it can become tomorrow. The comparable method, also known as comparable company analysis, is like window shopping for startup valuations. It involves comparing your startup to similar publicly traded companies in your industry. Let's say you're building a social media platform. You might look at the valuations of companies like Twitter or Pinterest. By comparing metrics like user growth, engagement rates, and revenue per user, you can get a sense of how the market values similar businesses. This method provides a benchmark, a starting point for determining your startup's worth. Money over time. The discounted cash flow method. This method is a cornerstone in financial analysis and valuation, especially for startups and businesses looking to understand their future financial health. The discounted cash flow, or DCF, method takes a more analytical approach, focusing on the time value of money. It's a powerful tool that helps investors and business owners make informed decisions by evaluating the potential profitability of an investment. It assumes that money today is worth more than the same amount in the future. This is due to inflation, risk, and the opportunity cost of not having the money available for other investments. Here's how it works. You project your startup's future cash flows, which are essentially the net amount of cash being transferred into and out of your business. This involves calculating your revenue and subtracting your expenses. It's crucial to be as accurate as possible in these projections to ensure a reliable valuation. You do this for a certain period, usually 5 to 10 years. This time frame allows you to capture the long-term potential and growth of your startup. Then, you discount these future cash flows back to their present value using a discount rate. This rate reflects the risk and the time value of money, ensuring that future cash flows are appropriately valued in today's terms. This discount rate accounts for the risk associated with your startup and the time value of money. Higher risk typically means a higher discount rate, which lowers the present value of future cash flows. The sum of these discounted cash flows represents your startup's present value. This present value is a critical metric that can help you make strategic decisions, attract investors, and plan for future growth. Balancing the scales. The scorecard method. The scorecard method is like a balancing act, weighing different factors to determine your startup's valuation. It assigns scores to various aspects of your business, such as market size, team experience, competitive landscape, and technology innovation. Each factor is weighted based on its importance, and the total score is used to adjust a baseline valuation. For example, a large market size and a strong team might increase your valuation, while intense competition might decrease it. The investor's view, the venture capital method. The venture capital method takes the investor's perspective, focusing on their desired return on investment. Venture capitalists typically aim for high returns, often in the range of 30 to 50% or more, to compensate for the high risk associated with startup investments. This method involves working backward from the investor's desired exit valuation and target ROI. Based on the investment amount and the desired ownership percentage, you can calculate the post-money valuation, which represents the value of your company after the investment. The valuation puzzle. Key factors. Understanding the key factors that influence your startup's valuation is essential for any entrepreneur. Each piece of the puzzle plays a significant role in painting the overall picture of your business's worth. Several factors influence your startup's valuation, each piece contributing to the overall picture. These factors are interconnected and collectively determine how investors perceive the potential of your business. Understanding these factors is crucial for justifying your valuation to investors. A well-rounded grasp of these elements enhances your ability to negotiate and secure funding. Market size. The larger your target market, the greater your growth potential. A vast market indicates more opportunities for expansion and revenue generation. Investors are more likely to invest in startups addressing large, underserved markets. They seek opportunities where there is significant room for growth and a clear path to capturing market share. Traction. Demonstrable traction, such as user growth, revenue, or partnerships, validates your business model and increases your valuation. Traction shows that your business is gaining momentum and has a viable path to success. Team. A strong, experienced team inspires investor confidence. The right team can execute the business plan effectively and navigate challenges. Investors bet on people as much as they bet on ideas. A capable team with a proven track record can significantly enhance your startup's appeal. Competition. A competitive landscape can impact your valuation. Understanding your competitors and differentiating your offering is crucial. A highly competitive market might decrease your valuation, while a unique offering in a less competitive market might increase it. Positioning your startup effectively within the competitive landscape can make a significant difference in how investors value your business. Making your case, justifying your valuation. Determining your startup's valuation is just the first step. You also need to effectively communicate and justify it to investors. This involves crafting a compelling story, backing it up with data, and confidently addressing their questions. Start by clearly articulating your startup's value proposition and its potential impact on the market. Highlight your achievements, such as user growth, revenue milestones, or strategic partnerships. Use data to support your claims, showcasing your progress and future projections. Be prepared to answer tough questions about your financials, competition, and growth strategy. Unlocking your startup's worth. Understanding how to value your startup is essential for entrepreneurial success and long-term growth. It empowers you to engage in meaningful conversations with investors, secure crucial funding, and ultimately achieve your vision. Remember, valuation is not an exact science, but rather an art informed by data, market dynamics, and your ability to articulate your startup's potential clearly. Embrace the journey, learn from experts, and unlock your startup's true worth and potential. Smash that like button if you got some value out of this video. Subscribe for more.